Okay, let's talk about something you've probably seen with your own eyes. You walk through any major city and you see them. These giant, empty office buildings, almost like ghost towers. Meanwhile, we keep hearing that the economy is doing just fine, that we're having a soft landing. But what you're seeing on the street tells a very different story, and it suggests a huge problem is hiding in plain sight. And this right here, this is the question at the very heart of it all. Because, look, this isn't just about empty desks and quiet hallways. It's about who is on the hook for the massive loans on these buildings. And the answer, which is regional banks, is exactly why this isn't just some real estate slump. It could be a brewing financial crisis. So you've basically got these two completely different stories being told at the same time. On one hand, you have the official line. Everything's fine, it's a soft landing, markets are normalizing. But on the other hand, you have the reality you can see, record high vacancies and landlords just walking away from their loans. Our job here is to cut through the noise and figure out which one of these stories the facts actually back up. So, first things first, let's dig into the evidence. We need to get past feelings and anecdotes and look at the cold, hard numbers behind what some are calling the office apocalypse. Here it is, the big one. According to Moody's Analytics, the national office vacancy rate has hit 20.7%. That is the highest it has ever been. I mean, just let that sink in for a second. That's more than 1 out of every 5 offices in the entire country just sitting empty. This is not a blip on the radar. It's a massive, historic shift. And the argument here is that this isn't your typical up and down economic cycle. This isn't a roller coaster that's just going to go back up. It's more like the ground has completely fallen out from under the market, a permanent structural change in how and where we work. Let's zoom in on a city that's really at the epicenter of this whole thing. Just look at San Francisco. Before the pandemic, the vacancy rate was a totally healthy 8%. Fast forward to today, and it's nearly 28%. That office space didn't just become vacant. The amount of empty space more than tripled in just a handful of years. You don't call that a downturn. That's a collapse. And this quote just nails it. The point isn't about when the market will recover. The point is that it might not. The argument is that the traditional 5-day-week office building is becoming obsolete, kind of like the horse and buggy was a century ago. And, well, you can't have a recovery for something nobody needs anymore. Okay, so if these buildings are becoming obsolete, what in the world happens to the billions and billions of dollars in loans that are tied to them? This is where it gets really serious. We have to follow the money and see who is most exposed to all this risk. And boom, here's the answer. This isn't a too-big-to-fail problem like last time. A whopping 70% of all this commercial real estate debt is sitting on the books of smaller regional banks. And yes, I mean the exact same kind of banks that we saw implode with Silicon Valley Bank. It's a huge concentration of risk, all in one place. So what are these banks doing about it? Well, the strategy has a name for it. Extend and pretend. Think of it this way. A landlord can't pay their mortgage on their empty building. So instead of the bank foreclosing and taking a loss, they just say, don't worry about it. Just pay us back in 5 years. They extend the loan and pretend everything's okay. It's the ultimate way to kick the can down the road and hide the problem from their balance sheets. And if you look at the headlines, you can almost see a PR campaign kicking into high gear. You have banks announcing strategic reviews, which is often just code for, we're trying to get rid of this bad debt. At the same time, you have the big players like JP Morgan telling everyone that markets are normalizing, even when the vacancy numbers are screaming the exact opposite. It really looks like a coordinated effort to control the story. But here's the thing. You can try to spin the story. You can control the narrative. But that can only work for so long. Because underneath all the talk, there is a simple and frankly brutal mathematical trap that no amount of PR can fix. Let me break down the trap for you. A few years ago, landlords got these loans at super low interest rates, maybe 2 or 3%. Now, those loans are coming due and they have to refinance. But two things have changed. First, their rental income has totally tanked because their buildings are empty. And second, the new interest rates are triple what they were, maybe 6 or 7%. So they have less money coming in, but their debt costs just tripled. The math? It just doesn't work. It's impossible. And we're not talking about a small problem here. The scale is just immense. We're looking at a $290 billion time bomb. That is the amount of commercial real estate loans coming due by the end of 2027, and pretty much every single dollar is walking straight into that mathematical trap we just talked about. So when you put all of this evidence together, it leads you to some pretty critical questions. Questions that, according to the source material, the people in charge really, really don't want to answer. Let's start with question number 1. If the market is really normalizing and getting healthy, why on earth are landlords practically giving space away? We're talking 6, 9, even 12 months of free rent just to get a tenant in the door. I mean, come on. In a healthy market, you don't have to give away your product for free for a year. The actions don't match the words. And question number 2. Where were the regulators in all this? Their whole job is to run stress tests on banks to make sure they can handle a crisis. Yet somehow, it seems they never bothered to test for a scenario where remote work becomes permanent and office vacancies skyrocket. Was that just an honest mistake? Or did they simply choose not to look for a problem they didn't want to find? And this might be the most chilling point of all. The exposure that banks have to this specific kind of debt is more than double what it was leading up to the 2008 crisis. Let me say that again. It is more than double the exposure that helped trigger the last global financial meltdown. So the big question is, why is nobody seriously talking about systemic risk?
All right, so what's the bottom line here? What does all of this add up to? Let's connect those final dots and get our reality check.
The core argument being made here is this: the financial stability we keep hearing about is really just a performance. It's a story, a narrative that only stays intact as long as we all collectively agree to ignore the empty skyscrapers and the impossible math. The whole system is being propped up by pretending. And that brings us to the final, haunting, and maybe unavoidable question. You can bend a narrative, you can spin a story, but you can't bend math. Eventually, the pretending has to stop. The loans come due, and the numbers are what they are. So what happens when mathematical reality finally forces everyone to open their eyes?